We shall now move on to the second part of this module, dealing with bank debts. There are two main categories of consumer debt. A debt can be either secured or unsecured. A secured debt is a loan taken with an asset as collateral. In the event that you cannot repay the loan, the bank may sell the asset to recover the money owed. However, if there is a shortfall after selling the asset, the bank may take legal action to recover the balance amount owed. In contrast, an unsecured debt does not require an asset as collateral. If you cannot repay, the bank may take legal action to recover the amount owed. Here are a few examples. An example of a secured debt is when you take a loan to buy a house or a car. An example of unsecured debt is when you have outstanding balances in your credit card account or revolving line of credit account. Other examples include loans taken for personal use, such as education and renovation. If you have outstanding balances in your credit card accounts, have you wondered why the balances in your accounts seem to get bigger despite making payments? That's because as long as you continue to make purchases with your credit card, making minimum payment is not enough to pay down the balance. If you're not able to pay the outstanding amount in full, banks require you to make at least the minimum payment. Minimum payment is generally determined by banks as 3 to 5% of your total outstanding balance or $50, whichever is higher. Let's take a look at an example of a credit card statement. Next, we will now see what happens when you continue to make purchases with your credit card while making only the minimum payment. Let's see how the following are determined. Minimum payment is 3% of opening balance. Interest charged is 2% of new purchases. Principal repaid is the amount paid minus interest, while closing balance is opening balance minus principal repaid plus new purchases. Assuming John has an outstanding balance of $10,000 in his credit card account, during the month he charges $1,000 worth of new purchases to his card. He makes only the minimum payment of $300 to his account. After deducting for interest, the principal repaid is actually $100. Adding the amount from his new purchases, John's closing balance for the month is now $10,900. In month 2, John's outstanding balance in his credit card account has grown to $10,900 despite making payment in the previous month. During the month, he continues to use his card and charges $1,000 worth of new purchases. He makes only the minimum payment of $327 to his account. After deducting for interest, the principal repaid is actually $109. Adding the amount from his new purchases, John's closing balance for the month is now $11,791. By the third month, John's outstanding balance in his credit card account has increased to $11,791. During the month, he continues to use his card and charges $1,000 worth of new purchases. Again, he makes only the minimum payment, which amounts to $354. After deducting for interest, the principal repaid is actually $118. Adding the amount from his new purchases, John's closing balance for the month is now $12,673. As you can see, if you continue using your credit card while making only the minimum payment, you will not be able to pay off your outstanding balance. Instead, the outstanding balance will continue to increase. How then do you go about paying off your outstanding balance? There are 3 things you need to do at the same time. First, stop using the credit card. You must also avoid using other credit facilities to pay your outstanding account. Next, pay your credit card accounts on time to avoid late charges. Lastly, stick to the initial minimum payment amount. Continue paying that amount regularly and do not reduce it even as the balance falls. Let's see what happens when John takes these actions. In the second example, John has a $10,000 outstanding balance and immediately stops using his credit card. At the same time, he sticks to a minimum payment of 3% of his outstanding balance. The minimum payment is thus $300. Assuming a 2% interest rate, the interest paid is $200 and the principal paid is $100. John's closing balance therefore decreases to $9,900 at the end of month 1. In month 2, John continues making a minimum payment of $300. After deducting for interest, the principal repaid is $102. Subtracting that from the opening balance, John's closing balance further decreases to $9,798 at the end of month 2. Similarly, in month 5, John does not use his credit card and continues making his monthly minimum payment of $300. After deducting for interest, the principal repaid is $108. Subtracting that from the opening balance, John's closing balance further decreases to $9,480 at the end of month 5. It's now month 55. By this time, John's outstanding balance has reduced to $433. After the minimum payment of $300 and interest charged, John's closing balance is $142. He just has to make one final payment to completely pay off his account. Let's now recap the 3 important things you must do if you want to pay down an outstanding credit card balance. You have to do all 3 things at the same time. First, stop using the credit card. Next, pay your credit card accounts on time to avoid late charges. Lastly, stick to the initial minimum payment amount. Continue paying that amount regularly and not reduce it even as the balance falls.